You really are looking for a business where you see the future. And that's why we don't get in tech. It isn't that I don't love the computer and think it's doing all kinds of things for society.
Why Warren Buffett would keep his hands off 99% of tech stocks, and why you as a private investor should not copy Buffett one-to-one, find out in today's video. Enjoy.
How do I value the business that Berkshire acquires? Well, the first thing I have to decide when somebody calls me is valuing this business within my circle of competence. I don't know how to value Microsoft. I don't know how to value Oracle. I mean, if Larry Ellison calls me or Bill Gates calls me and I don't know biotech or anything, I wouldn't know how to value it. I just, I'd wish them well and tell them, I think it's worth twice as much as they think it is, but I'm just not in the mood to buy today. So it has to be within my circle of competence. Businesses I can understand. And when I say understand, I don't mean understand how to use a computer or not use a computer in terms of a computer company. I mean understand what the economic characteristics of the business are and what the company's really going to look like in 5 or 10 or 20 years.
And this brings us to the point that is so often misunderstood. Buffett understands the business model of Microsoft and Oracle. He knows that Microsoft sells operating systems and office solutions. He knows that Oracle develops and sells enterprise software. But he is not sure what the business will look like in 5, 10 or 20 years. Precisely because there is a lot of competition and innovation in the tech sector, he shies away from these companies. Because that makes it extremely difficult to plan ahead where the companies will be in 5 or 10 years. And many people are confused now because Buffett bought a huge chunk of Apple stock in 2016. And to break it down right away, Buffett gave this talk in the early 2000s, before Apple came out with the iPhone, before Facebook or Netflix were big names. And at that time he was simply not willing to invest in the big players like Microsoft, Oracle, IBM or Cisco, not because he didn't understand the business model, but because he had a hard time predicting the future of these technology companies.
Bill Gates will tell you that if he were investing, he would buy Berkshire rather than Microsoft because it's so much easier to understand what our businesses are going to look like, whereas he's in a business where you're going to really have to be doing things differently over time. So I know that Wrigley's is going to be the number one chewing gum in the country. I know Snickers is going to be the number one candy bar in the country 10 years from now. It's been the number one candy bar for 40 years. You don't have to be very bright to understand that when people lay out 50 cents for something that they stick in their mouth, that they're not about to experiment. So we try to look at businesses we can understand. Now I got a call a year and a half ago from a fellow, I never heard of him, in Denver. His name was Craig Ponzio. Craig called me up and never heard of him, and he said, I've got a business, it's your kind of business, I want to sell it, there's the reasons, have to do with health, and he said, it's the leading company by far, the custom picture frame business. He said, let me tell you why it has what I call durable competitive advantage. He said, let me tell you why it has it. He said, there are 18,000 people that frame pictures in the United States, little mom and pop operations. Every town, Lincoln will have a half a dozen, Omaha will have a dozen, and they frame pictures. I go over to get a picture frame, and I hand it to somebody, I say, I follow their judgment. I say, biggest thing I want is I want a good looking frame, and I want it back soon. I want quick delivery. Well, with 18,000 people in that business, and a zillion kinds of picture frames, nobody can carry a big inventory because they don't do that much business. I mean, it's not Walmart or something of the sort. Craig Ponzio graduated from a little school up in Wisconsin, went to work in a tiny little firm that made these things. 5 or 6 years later, bought the place when it was doing $3 million a year. Now does $300 million a year, and it totally dominates the wooden custom frame business. Why does it dominate it? It dominates it because it calls on these 18,000 people. It has a sales force calling on them 6 or 8 times a year, and it has 22 plants around the country that can get the frame that the custom framer orders 85% of the time. If they order it by 5 o'clock today, they'll have it by 3 o'clock tomorrow afternoon. That's what the customer wants. They don't care whether they pay $83 or $88 to get got something you want done, and you want it done fast. And that little custom framer, those 18,000 people, they want happy customers, and that means speed of delivery and certainty and all that. You couldn't build a distribution system to compete with us. I mean, just think of trying to build a distribution system starting from scratch that would take that business away from us. It can't be done. Well, Craig explained that to me in about 15 minutes. I'd never thought about the custom frame business, but I framed pictures or had people frame it for me, and I understood the power of that. That was a Monday. I said, I think we can make a deal. So he came on Wednesday. He came at 9 o'clock and he left at 10 o'clock. We've had a deal. I've never seen him since. He got the money promptly thereafter. He wasn't going to come to the annual meeting last year, but his wife was sick. He'll probably come this year. He's a good guy.
Buffett stresses the importance of a long-lasting competitive advantage. That means a company has to be able to keep the competition at bay. And that can be done, as in this example with the custom picture frames, by having a customer relationship with 18,000 mom and pop stores across the country. And what makes this customer relationship work is reliability and fast delivery, which reminds me a bit of Amazon's moat today. Alternatively, it can be done by having a brand with recognition value, such as Coca-Cola, Snickers or Wrigley's chewing gum. Or another example, a unique location of, say, a restaurant in the middle of downtown New York. And Buffett didn't see this long-lasting competitive advantage in tech companies for a long time, until Apple came along with the iPhone, which is now by far his largest position in his portfolio. And he also saw that competitive advantage with Amazon or Google. He already said that he recognized these moats too late with these companies and that the prices were then no longer attractive enough for him. At Amazon he even has 10 million shares, but this does not even represent 1% of his portfolio value.
And no one can knock us off in that business. Every time I buy a business, I say to myself, if I had $1 billion and I wanted to go and compete with these guys, could I knock them off? If you gave me $1 billion and you told me to dislodge Snickers as the #1 candy bar in the country, I don't know how to do it. If you tell me I got $1 billion and I got to make it, or $5 billion, and I got to make it so that Wrigley's, all of those get knocked off the top selling gum list, I can't do it. You know, if you give me $1 billion and tell me to knock off all the ladies' apparel shops in Lincoln, you know, I'll make mincemeat of them very fast. I mean, I have a very good business myself, but I can destroy that. And the real test is, you know, can some idiot with a lot of money destroy the business you've got if he decides to compete with you? And we try to buy businesses where no matter who comes along, they've got this durable competitive advantage. Those are the 3 words that count. And you may be able to make that decision about companies that I can't make that decision about. They have to be pretty simple for me.
This is where the mental model of Charlie Munger comes into play, namely to invert everything. That means Buffett asks himself the question, how can I make the biggest mistakes when it comes to investing? And one answer is by buying companies that are extremely complex, that I have a very hard time estimating the future. So companies with a lot of competition, companies in an industry with a lot of change, so a lot of innovation. And then staying away from those companies. Unless we take the example of Apple, there is a huge moat which makes the forecast easier again. Buffett recognizes that the people are attracted to the Apple brand, and no matter what new things come into the market, be it the most amazing Samsung smartphone with 12 cams, people still buy the iPhone.
You know, we have Fruit of the Loom underwear. You know, are people going to quit wearing underwear? Well, who knows? But we sell 44% of all the men's and boys' underwear that goes through Walmart and all of the mass merchandising chains. We've got the lowest costs around. Fruit of the Loom is a name that's been around since 1850 or 60. If you can buy 3 pairs of shorts from us, or 6 pairs or whatever it is, for $5.50 and nobody's going to sell them cheaper, why are you going to buy anything else? You know, so we'll own that unless we mess it up some way. We've got a very potent advertising slogan there. We cover the asses of the masses. That sort of gets to it, doesn't it? You really are looking for a business where you see the future. And that's why we don't get in tech. It isn't that I don't love the computer and think it's doing all kinds of things for society. I just don't know what it's going to look like in terms of who's going to be selling what to whom and at what prices and against whom and all of that sort of thing 10 years from now. Whereas I know that people are going to be chewing Wrigley's chewing gum in 10 years. There are certain things that won't be affected. Gillette razor blades. I mean, you know, that 70% of the value worldwide of razors and blades is Gillette. That's after almost 100 years of shaving, and everybody knows what a razor blade does. They all know how to buy the steel. They all know how to sell it through Walmart or whomever. But 70% of the world. Now, part of that's because men don't like to change as much. I mean, men gets happy with something. He doesn't fool around with it a lot. Women are a little more inclined to experiment. But $25 a year, something you do every day, you get a wonderful experience with Gillette. What better is the world going to offer you?
Here I would like to go into more detail about Buffett's current investment approach. Because there is this saying, don't do what they say, do what they do. And this only applies to Warren Buffett to a very limited degree. Because when Buffett had small amounts of money, as we usually do as private investors, he made very different investments than he does today. He focused on small, extremely low-cost companies, and a long-term competitive advantage was less decisive for him. Because he also sold these small companies more quickly in order to secure secure the next low-cost company. Only in the course of the decades, as his mountain of money became bigger and bigger, did he get more and more involved in high-quality companies with a long-term competitive advantage. His best performance was in the 50s with about 50% return per year, and he says if he had little money he would take this approach. That is to put money into small low-cost companies and sell them when they reach their fair value. This approach of course requires much more work in my opinion. It may be riskier but promises higher returns, and especially we as private investors have the advantage that we can invest in companies that fly under the radar of the big asset managers and banks, simply because an investment in these companies would have little impact on the overall assets of the big companies. If you are interested in this approach, with the Seeking Alpha platform you can find high quality stock analysis even on smaller companies that are hardly noticed by the big investors. I use Seeking Alpha for almost 2 years. I have my watchlist there where I look in daily and get the last company reports and stock analysis to this watchlist. With the first link in the video description you get $140 discount on the Seeking Alpha annual subscription and save almost 60%. And now I'm interested in your opinion. What do you say about Buffett's statements on tech stocks? Feel free to write it in the comments below.